If a bank looked at your tax returns and said, no, there's still a way to buy that rental property, it's called a DSCR loan, and most people have never heard of it. Real estate investors use it constantly. Self-employed buyers use it to get around income documentation problems, and once you understand how it works, you'll wonder why more people don't talk about it. Let's start with the basic problem. Traditional mortgages look at you, your W-2s, your tax returns, your personal debt-to-income ratio. If you're self-employed, if you write off a lot of expenses, or if you're buying your fifth rental property and your personal income doesn't support another loan on paper, a conventional lender will often turn you down. Not because the deal is bad, because the paperwork doesn't fit their box. DSCR stands for Debt Service Coverage Ratio. Instead of qualifying you based on your personal income, it qualifies the property based on its own income. The lender asks one question: does the rent this property generates cover the mortgage payment? That's it. No tax returns, no W-2s, no personal income verification at all in most cases. Here's the formula. Take the property's monthly rental income and divide it by the total monthly debt payment, which includes principal, interest, taxes, insurance, and any HOA dues. That's your DSCR ratio. A ratio of 1.0 means the rent exactly covers the payment. Above 1.0 means the property cash flows. Below 1.0 means you'd be paying out of pocket every month to cover the shortfall. Most DSCR lenders want to see a ratio of at least 1.0 to 1.25. Some will go lower, even down to 0.75, but expect a higher interest rate and a larger down payment to offset that risk. The stronger the ratio, the better your terms. Let's run real numbers. Say you're looking at a rental property with a market rent of $2,000 a month. Your total monthly payment, including taxes and insurance, comes out to $1,600. Divide 2,000 by 1,600 and you get a DSCR of 1.25. That's a strong number. Lenders like that. It tells them the property comfortably supports itself, with room to spare if a vacancy happens or expenses go up. Now flip it. Same payment of $1,600, but the market rent is only $1,400. Your DSCR drops to 0.875. You're below 1.0. The property doesn't fully cover its own debt. You can usually still get the loan, but expect stricter terms, because now the lender is taking on more risk that you'll need outside income to keep the payment current. So who actually uses these loans? Three main groups. Real estate investors scaling a portfolio, especially once they've hit 4 or more finance properties and conventional lending options start drying up. Self-employed borrowers whose tax returns show reduced income because of legitimate business write-offs, even though their actual cash flow is strong. And buyers using an LLC to purchase property, since DSCR loans are commonly written to a business entity rather than an individual, which conventional loans typically won't allow. There's a trade-off, and it's important to say it plainly. DSCR loans are not cheaper than conventional loans. Interest rates typically run 1 to 2 percentage points higher. Down payments are usually higher too, often 20 to 25%, sometimes more depending on the ratio and the property type. Closing costs can include origination fees that conventional lenders don't charge in the same way. You're paying for flexibility and speed. The underwriting is faster because there's less paperwork to verify. Some DSCR loans close in 2 to 3 weeks instead of the 30 to 45 days a conventional loan can take. Another thing worth knowing: DSCR loans are almost always for investment properties, not primary residences. You can't use one to buy the house you're going to live in. Lenders require the property to be non-owner occupied because the entire underwriting model is built around the property producing rental income. If you try to use a DSCR loan for a primary home, you won't find a lender willing to write it. There's also a subtle detail that trips people up. Some lenders use actual signed lease income if the property is already rented. Others use an appraiser's estimate of fair market rent, called a rent schedule or Form 1007, if the property is vacant or you're buying it fresh. That number can differ from what you personally think the property will rent for, so it's worth getting a realistic rent estimate before you fall in love with a deal, so you're not surprised when the DSCR comes back lower than expected. Should you use one? If you're buying your second, third, or first investment property and you have strong personal income and clean tax returns, a conventional investment property loan will almost always be cheaper. Save the higher rate for when you actually need it. DSCR loans earn their value when conventional financing isn't available to you at all, whether that's because of self-employment, income complexity, portfolio size, or wanting to close in an LLC. The bigger picture here is that DSCR loans exist because the traditional mortgage system was built around one kind of borrower, someone with a steady paycheck and simple tax returns. Real estate investing has never worked that way, and self-employment has become far more common than it used to be. DSCR loans didn't reinvent lending. They just built a lane for people the old system was never designed to serve. So if a bank has told you no because of your tax returns, that's not always the end of the conversation. It might just mean you're asking the wrong kind of lender the wrong kind of question.